so much for joining us for today's Cherry Bekaert webinar. My name is Madeline Robbins, and I am our production manager at Cherry Bekaert. We have an impressive group of attendees on today's session, and we'll be offering up 1 hour of CPE. Now, in order to receive CPE, you must answer at least 3 of the 4 polling questions and attend for the full 15 minutes. Those CPE certificates will be issued via email within 10 days. If you haven't received yours after 10 days, email cbhlearning@cbh.com. A recorded version of the webinar will also be available in about a week and sent via email. Now, if you have any questions during the webinar, that control panel down at the bottom has a Q&A window. Go ahead and click on that. Send us any of the questions you have, and we'll get back to you as soon as possible. Just note, we do have a short survey that will be posted at the conclusion of the session. We value your feedback and ask that you take part. Okay, with that, we have a wonderful panel today to guide you through our session. And with that, Kathy Stanton, State and Local Tax Leader and Cherry Bekaert Partner, along with Tony Kunkel, Cherry Bekaert State and Local Tax Manager. Please, Kathy, take it away.
Okay, great. Welcome, everybody. We're happy to have everybody joining this webinar today. It looks like we have a lot of people signed up, so that is good. It makes it worth all of the work to put this together. So Tony and I have been working on the pass-through entity elections since they have come out. And just a lot of activity. I would say, you know, next to Wayfair back in 2018, that this would be probably the biggest thing that's happened in the state and local tax world in the past 3 decades that I've been working. So welcome. And today's agenda, we are going to be looking at background and general mechanics of pass-through entity tax elections. I know a lot of people are attending today more for the updates and what's happened, but we have to give some basics because I believe there's a lot of people also that may not have a lot of the basics or background or understand how it works. Then we're going to look at pass-through entity tax elections in 2023. Where are we now? There's been a flurry of activity. Pass-through entity tax election summaries. We're going to look at some of the new states for 2022 and look at those specific states and how those work. And then we're also going to discuss some special issues and other considerations. On the surface, it looks like this would be easy. And we have a lot of clients say, isn't this just a box you check on the return? Unfortunately, it's not that easy. And unfortunately, as everything goes in state and local tax, nothing is the same between the states. So first, we're going to start by asking a polling question. We're just going to ask, how did you hear about the webinar? Did you hear about it through a tax advisor here at Cherry Bekaert, an email, a friend or colleague, one of our alum, or a social media post? Hopefully it's one of those. I can't think of another way to hear about it, but we'll give you a few seconds or up to a minute here to answer. And this is for the CPE credit. We want to make sure that you're able to get credit for this webinar. How'd you hear about it, Tony?
I think I'm going to go towards A.
Cherry Bekaert Tax Advisor told you that you're presenting on this webinar. Yeah. So
I think an email that came through from you about a month ago.
Yeah, exactly. So Tony and I have been doing webcasts, both internally and externally. We've been doing podcasts. We've been doing a lot with this pass-through entity tax election. So it's definitely not our first time by any means.
No, and the votes are in, so thank you guys so much. As Kathy said, just make sure you are taking the polls along the way.
All right, great. So let's get started. Background and general mechanics. Okay, the history and background of the SALT, which is simply state and local tax cap. So TCJA, Tax Cut and Jobs Act, actually established a $10,000 cap on the amount of state and local taxes that individuals can deduct. And that would be all state and local taxes, including property taxes as well. So and it only applies to individual taxpayers, not corporate taxpayers. So as pass-through entities, all the income is taxed on the individual return if the pass-through entity is owned by an individual. And so if you have very profitable pass-through entity, that individual can only deduct $10,000 of state income tax. That would include even their personal property tax on their home. So it was a severe limitation to the deductibility of taxes at the individual level. Whereas if a business is conducted in a C corporation, all of those taxes can still be deducted. This was looked at as a political maneuver against some of the Democratic states as well. New York and California have very high tax rates, and they viewed it as an attack and a tax increase on their states, that it was purposeful. But regardless, it was estimated to produce a lot of revenue at the federal level, and this $10,000 cap went into place. And it's effective for 2018 tax year through 2025. In 2026, the rules revert back to the pre-TCJA no SALT cap, unless it's extended or made permanent. And then you might have seen in the news, there's been some recent activity of potential changes to the SALT cap, like you're not allowed any state and local taxes if you make over $1 million, or if your income is less than a certain amount, you're allowed all your state income taxes or more state income tax deduction. So there's been all kinds of talk about that and changing that as well. But right now, the way it stands, 2018 through 2025, this is where the opportunity potentially is to actually put a business back on par with a C corporation and be able to deduct state taxes. So the IRS issued guidance on November 9th, 2020. They issued notice 2020-75, and they announced the intent to issue proposed regulations to clarify the deductibility of certain state and local tax payments. And they basically put a bit of a stamp of approval that this should generally work, because you had, a lot of states that tax pass-through entities at the pass-through entity level already, and those taxes were always considered deductible. By the way the deduction works is that the K1 from the pass-through entity, that line 1 ordinary income, would have the state income taxes deducted. So it would be a deduction on the pass-through entity return, and that would flow through as lower income that's flowing through to the owner's return. So that's how that benefit is achieved. Now there's the IRS notice was not expansive. It didn't give a lot of information. It wasn't an explicit blessing as we have there at the third bullet. So we don't know what's going to happen until the regulations are issued. Are they going to issue regulations? So there's still some question. As of today, certainly no regulations have been issued. So there's still some question, but it kind of put a stamp of approval on this methodology to get around the SALT cap, which we call then a SALT cap workaround. Okay, we have lots of information. I know you have a lot of questions already, but hopefully a lot of information we have on these slides coming forward will help to answer some of those questions. But mechanically, the SALT cap workaround generally follows one of two approaches. Either and both of them, you're taxing the pass-through entity. So that pass-through entity has to file a tax return in these states. You're making some form of election. Connecticut is the only state where it's mandatory, but all the other states, you're making some form of election. And Tony, feel free to keep me honest if I miss one of those.
I'm the fact checker. Yeah.
He's the fact checker for sure.
Connecticut is the only mandatory state. So
Thank you. So generally it's an election. And so the way it would work is the pass-through entity would make an election. The pass-through entity itself, its return, the tax would be calculated, the tax would be paid just as if it's a corporate income tax return. And then when the individual files their individual tax return within the state or in their resident state, generally they're going to start with federal AGI. Well, that federal AGI is already going to have this pass-through income in the AGI. So you either have to deduct that income from AGI, or a tax is calculated and you're able to take a credit to remove the double tax. So at the individual level, there has to be an element for this to work, for the individual to remove that double taxation at the individual level. So states differ with that. Some states have a credit method where if the tax is computed at the individual level again, but then they get a credit for the tax paid at the pass-through entity. And then other states follow an income reduced method where they start with that federal AGI, but if there was income taxed at the pass-through entity level, they can remove that income. So it's an income deduction as opposed to a credit. So we have there the states that are some examples of that each follow the different methodologies. We would have really liked states to just follow one uniform approach and just adopt, uniform statutes. So everything was the same. Unfortunately, every state has to do things their own way, and they have their own considerations and tweaks that they need to make. So we have, and Tony will talk about more details, but we have seen tremendous differences between the various states. So these rules, we don't say this just, so you hire us to help you with this, but I mean, there are just complexities to this that you want to make sure you don't make any serious missteps anyway. Okay. Now, where are we now in 2023? The landscape. Okay, so when the IRS issued notice 2020-75, only 7 states had enacted legislation for an entity level tax on pass-through entities. So now, as of March 2023, 30 states and New York City have passed legislation to create the entity level tax regime for a pass-through entity. So you can see the difference that this notice made. They thought, okay, IRS, we're interpreting this as a stamp of approval, that we're just going to do this workaround. And this, keep in mind, the reason this can happen so quickly too for the states is that this is all revenue neutral for the states. They're either getting the tax at the pass-through entity level or getting it at the individual level. It's completely revenue neutral. It just gives their residents, their constituents, an ability to deduct taxes on the federal return, which subsidizes the tax obligation. Depending on what effective rate, it could be up to 37%, subsidizing 37%, which is the way it was before TCJA, which is why the Democratic states were, or the states that are Democratic mostly, were really upset when this came into being. So here we have some more details. I'm not going to go through this in detail. We have in the slides you can read because I want to make sure we have enough time, because we always run out of time, Tony, to get into some of the more meatier issues. Okay. 30 states have jumped. We mentioned that 6 states have introduced legislation since this January. And Indiana introduced their pass-through entity tax legislation this January and signed it into law in just over 6 weeks' time. Don't have a lot of guidance yet, which Tony's going to talk about, but it's signed. So they are the 30th jurisdiction. So we're at 30 states plus New York City. New York City, by the way, is really going to be beneficial for people that are New York City residents, because generally you still have the unincorporated business tax at the New York City level. So you have different nuances that happen at the city level. So again, and then also the last bullet on this slide talks about earlier attempts at state SALT cap workarounds before this one really took hold and all the states really went down the road of having pass-through entity taxes. There was the charitable contribution. Make a charitable contribution to a state fund and we'll give you a tax credit. Well, the IRS pretty much shut that down in many situations, that no, you can't get a charitable deduction. You can't convert your tax liability into a charitable deduction. So that didn't work. And then New York had a payroll tax, converting it to an employer compensation expense program, which was not easy, did not take off. And actually, if I remember right, I don't know if you remember, Tony, but if I remember right, it actually cost the employer something. So it wasn't like neutral to the employer. It was a little bit of kind of a cost.
Yeah, it was kind of just it was confusing. It was difficult.
Yeah.
It never really had much adoption. But, usually before we put together some of these presentations, I always want to check on this one. I think it just makes for like a fun example of things that were tried before, just to see if it like is still out there. If it was repealed, it's still there. Still
It's
an
still
option.
there.
Yeah.
It's still there. Yeah. So if you want to look at that, I think I remember, don't quote me on it, but I think there ended up being some cost, but certainly administrative costs too, to that. Okay, the earliest state to enact, Connecticut, Wisconsin. Connecticut's mandatory. But you know, most of these states now that had more recent legislation, they've been able to look at these states that have adopted, and they could kind of choose, okay, what do we think is going to fit best with our state? And they have kind of at least kind of a model that they can look at. Although I don't think any state has adopted exactly another state's
No.
legislation. You know, they have to have their own thing. You know, we are talking about the United States of America.
What I see in a lot is just particular pieces of language that start,
Yes.
you know, you see in a lot of other pieces of legislation, but kind of picking and choosing from other different states.
Yes.
You know, the very similar language maybe isn't coincidental, I think.
Yeah. So this might not be a perfect solution. You know, you may have income outside of pass-through entities. You may not get a full credit, which we'll talk about, but it's still very helpful for profitable businesses, right? Profitable pass-through entities. And we see in our practice that unless you have a reason to be a C Corp, generally pass-through entity is still the favored way to go, because there's no double layer of taxation when you want to you know, divest of that business. So there's still tax advantages to that. Some view an S Corp as having some tax advantages on the payroll side. So it's still preferred to be a pass-through entity, even though although now you have corporate rate at the federal level is a bit lower than the individual rate, but still you still have that double layer of taxation. So it's not a perfect solution, but we see clients that are very sophisticated, very large companies that are pass-through entities, and to have lost that deduction was huge. So this is very, very favorable for these companies at the state level. So at that point, we're going to take our polling question number 2. How many states have enacted the pass-through entity tax regime, whether it's mandatory, which is only Connecticut, or the others? How many? Oh, and we're going to include New York City. Okay, so how many jurisdictions, states including New York City, how many jurisdictions have enacted? A, 13, B, 25, C, 31, D, 50. How many jurisdictions? I would hope that everyone would do pretty well on this. You made this one easy, Tony, I think. We could have had a cluster of numbers around the same. You're kind.
Now I ran the numbers again, and now at this point of states and counting DC too, so jurisdictions that actually impose an income tax. So taking out the 9 states that don't have some kind of income tax, you're only down to 7 jurisdictions with an income tax that have either not enacted a PTE tax or at least have some kind of current legislation.
They're facing a lot of pressure. Once a whole bunch of states take off in a certain area, then the constituents of a state that have not done that, they're just like, hey, what about us? We want this. I mean, the thing that comes to mind is legalizing marijuana for some reason. You know, it's like, hey, I want it too in this state, right?
Online gambling too is amazing, right? Like when it comes to vices,
when it comes to vices, especially, you probably get more push. Although there is a number of states now that have pushed back on legalizing marijuana, which I find, you know, interesting. Everyone has their personal views on that, but we do see the answers. We won't get off tangent too far. Most of you got it right. It is 30 states plus New York City. Not all 50 states even have an income tax. So I would expect that person that voted for 50 probably is not a tax person. So
that was me.
Yeah, but we won't.
You know, I think I would be the most mad if I was in Pennsylvania, as I'd kind of mentioned there before and emphasized the current part. Pennsylvania is a state that in 2 prior legislative sessions has introduced a bill that expired without getting voted on, died in committee. And so far in the most current session, they haven't reintroduced it again. So,
which is so interesting because it's revenue neutral. And so I don't personally know the politics behind that one. I don't know if you've heard the politics behind it, but it does sound, maybe other things were attached to that, or I don't know.
Yeah, very possibly. I just caught about Vermont has a current bill, and
Yes.
Bloomberg recently had a good article with some of the background information where, like, last year they had, did the same thing, introduced it and died in session without, um, making it really out of committee.
Yeah.
And one of the things that they were kind of hung up on was actually whether they were going to do a dollar for dollar credit, or
Ah,
the
yeah.
current bill that's, moving its way through right now and might pass is one that would be a 90% credit.
So they're trying to make it actually a
Yeah.
revenue positive for them as opposed to
Mhm.
revenue neutral. Of course, you're going to get some pushback there because that's an increase in taxes.
Yeah.
So here we have all the states with pass-through entity elections currently. We'll talk about the retroactivity part in the future slide, but that's going to be interesting and challenging and fun having this apply retroactively. And then we did have a difference in effective date in Wisconsin, depending on what type of entity you were as well. So here are all the states to date. And you can see the first applicable year. So see all of those with 2022. And hopefully, the rest of them will probably come along here, except maybe Pennsylvania for whatever reason in 2023. So now we're going to get into pass-through entity election, tax election summaries new for the 2022 year, because this is the tax compliance season we're in now. Extensions are due this month, next month for this tax year if you're on a calendar year. It'll be future if you're on a fiscal year. So this is what you have to really decide kind of quickly now, potentially, because elections do need to be made for many states at the extension date. So Tony, I will turn this over to you to talk about more of the facts, because you're the fact checker and you are the one in the better position to talk about facts.
Thank you, Kathy. Starting out with Georgia, a state that almost doesn't feel so new to me. I think it was like in late 2021 or early 22, Georgia enacted their PTE legislation, and was pretty good about getting some guidance out. So we had a pretty good head start on Georgia. But, now that we're into this 22 filing season that the year's concluded, we're finally starting to see where, we're doing Georgia electing PTE returns. And I'm like, I feel like I've been looking at Georgia for such a long time. But, here we are. At long last, we can now make elections in Georgia for 22. So Georgia, their methodology is an income reduced method. So owners are going to be able to take that deduction on their Georgia returns for the amount of income taxed at the entity level. So for Georgia, they're taking a methodology where it would be that Georgia sourced, apportioned, or allocated income for both residents and non-residents of Georgia. So this is yet another issue where states kind of take some different approaches. So, the oversimplification before was, the income reducer credit method state. But even within then, there's so many different approaches as you start to really drill down here. As we'll discuss with some other states, some states would just allow for a resident individual their entire unapportioned share of income in the PT tax. So a bigger amount of tax paid by the entity on their behalf, but also a bigger deduction for federal purposes. So for Georgia, just to make things simple, I feel like they just did an apportioned Georgia income for residents and non-residents.
And that's a good point, Tony. Like that difference, and this is a significant difference between some of the states. It's really important to understand. Your K1 that you get. So Tony's saying in Georgia, even if I'm a resident, it's going to be my Georgia sourced income that this election applies to. But in some other states, it's my entire K1 income. So regardless, so if you have some nowhere sales where you're not paying tax in all states because you don't have nexus, you're still going to get a deduction because that tax reverts back to your resident state. You're going to pay tax on everything in your resident state. They're allowing you to get that deduction on everything in your resident state. So that is very, very beneficial for owners, pass-through entity owners that reside in states that allow you to include the whole K1 income.
Yeah, and maybe there could be some future legislation. Maybe Georgia has a change of heart on this, where we're seeing states that are afterwards seeing the outcomes, maybe some like unintended consequences that are passing, just like Virginia right now, with some pending legislation that would take a very different approach. Entity election that would beforehand kind of prohibit a lot of entities to be able to make the election. So maybe Georgia will eventually change that. Let's hope it, make for a much better opportunity for a lot of Georgia resident owners of PTEs. But otherwise, Georgia has a fairly straightforward election process. It's made on the return. It's the same partnership or S corp return that in years past those entities would file. Even a lot of the same extension payment forms didn't change for Georgia. Partnerships and S corps are going to be your entities that are eligible generally, but Georgia does have a bit of a restrictive ownership requirement to be able to make the election. We're seeing there are just a handful of states that kind of have these all or nothing rules where if the entity doesn't meet these ownership requirements, they're just prohibited entirely from being eligible to make the election. Unfortunately, Georgia is one of those states. So they kind of shortcutted and really just kind of went to the IRC 1361 S corporation eligible shareholder rules for federal income tax purposes. So eligible entities are either going to be S corporations, or in the case of partnerships, well, anybody who could be an eligible S corp shareholder. So they just kind of cut right to the chase with the federal rule, because the federal rule would kind of who can be eligible shareholders. Well, for the most part, individuals, and then some very narrow categories of grantor trusts of some other types of taxpayers. But otherwise, the tax rate is going to be the same. Georgia, 5 3/4% tax rate for residents and non-residents. In the case of non-residents, it does kind of the regime that they've set up kind of streamlines the process for non-residents. So electing entities, they're prohibited from filing deposit returns, but that's a good thing because otherwise they don't need to. They can cut it out entirely. Non-residents don't have to file their own separate Georgia individual return. And the PT itself is relieved of withholding requirements on non-residents. So basically that election takes care of any of the non-residents' other filings, unless they have income from other sources in the state. But next, we have Indiana, which is the newest one. You should have seen my browser before this. I probably had 20 tabs open just to make sure that I was up to speed on Indiana and all these different nuances, kind of scratching my head going, wait, what do we do here? When can we first do this? So Indiana, it was signed into law February 22nd. As of right now, we kind of have some limited guidance, really not any from the Department of Revenue at this time. It's just the statute itself or the piece of legislation, which, like a lot of other states, it leaves a lot open to the Department of Revenue to issue guidance and everything they need to carry out the legislation. So as of right now, how the election's actually made, TBD. We're not sure.
And it's for the 2022 tax year. So the extensions too, we don't know how the election's going to be made yet. So we say extend.
Yeah, I thought it was very promising, at least on their Department of Revenue website right now. They at least have a, what they call it, Senate Bill 2 webpage. So they kind of have like a placeholder right now for the PTE tax that with just a big box of more information coming. So at least they're aware. They've heard of it. That's good news.
At least they got the legislation through.
Yeah. Yep. So at least the statute gave a little bit of a head start. They said for the 22 tax year, the election cannot be made before March 31st, 2023. So, I mean, we got like 3 more weeks to at least have some amount of guidance here, but either way, couldn't make the election technically right now anyway. So it's going to be an annual election. It's taxes going to be computed on all owners of the PTE. So with one exception, I kind of outlined below there. But so this would be one where Indiana doesn't really have any kind of ownership limitation as compared to Georgia. So if the entity makes that election, they're just going to compute the PTE tax on all of the partners, shareholders of the electing entity. But they would carve out, there's one exception made for like banking financial institutions subject to like the, state's bank tax. And then they kind of had an interesting part in there, and it was something to the effect of, and any other entity determined by the department. So subject to some change here. There could be some other categories of partners, shareholders that maybe they want to just carve out of it, and the Department of Revenue would have the authority in the statute to be able to do that. But generally, partnerships, S corps are going to be the ones eligible to do it. The tax is just going to be the rate in effect for the tax year. So that would be 3.23% right now, slightly less for 2023. And I'll say here, computed on the Indiana source income of non-residents, but the entire distributive share for a resident owner's PT income. Just caught this one, catching little things in the legislation before we did this presentation. The entity actually has the option here. So it can just be Indiana source income for everybody, or they have the option of doing that entire distributive share of income for residents. However, it's that if they're going to pick a methodology, it has to apply to all owners of the entity or all the residents. So it kind of gives a little bit of flexibility, which I thought was nice. I hadn't caught a state that gave that option before.
that's
so
a
that's
first.
actually a new one.
Yeah.
Kind of caught me off guard there.
That's
So
yeah.
So electing PTs are not subject to withholding. So Indiana's pass-through entity returns kind of are just a mandatory withholding and composite return in one. But the PT election basically satisfies both. So before, with the mandatory composite for Indiana, non-residents wouldn't have their own separate individual filing requirement anyway, unless they had other sources of Indiana income. So the election sort of didn't really change that, since Indiana kind of already had this mandatory withholding and composite before. So the PTE tax is kind of just a substitute for the withholding. But if they make the election, non-residents still would, unless they have other sources of income, would not have, a further filing requirement in Indiana. But keep a lookout for additional guidance on there. With estimated taxes, given the timing of this legislation, there's a bit of a pass that Indiana is giving. So what was it for 22? No estimated payments for tax years ending before June 30, 2023. So what would this be for this year? It's a 50% estimated payment requirement for the tax year. So it kind of like gradually goes up in steps until through 24, and then it goes up to an 80% of the tax due on the return for the tax year estimated payment requirement for the year. So they weren't too harsh. I feel like it was kind of like a nice tiered approach given the timing of the legislation. But, thankfully they at least made it available, for the 2022 year. So.
Okay, ready for the next?
Let's go for it.
All right, Missouri.
All right. Another newcomer here. This was one of the later states in 22 to enact a new piece of legislation here. So otherwise, we kind of had a quiet last half of 22. When I was kind of taking an inventory of everything new, I think it was in the last half of 22, we didn't have any activity or new states. But then right when, January this year started, state legislatures were back in session, they got the ball rolling pretty quickly. And we had 5 new states introduced legislation. Indiana already got theirs through.
And we actually had a pass-through entity tax webinar update in the fall. So we're not covering all the states that have enacted in 2022. So if you want to hear about earlier states, you can probably find that on our website, for the earlier states that enacted. Yeah.
Missouri is going to be another credit state. Owners would get a credit, from the electing entity that they can apply towards their own Missouri income tax liability. One interesting thing I thought about Missouri was not that it's a non-refundable credit. For the most part, most states take the approach that are credit method states that the credit would be refundable. There are a handful that, like California comes to mind, Arizona, where it's non-refundable, but you get a 5-year carry forward. So at least you have like a defined window to use the credit. So it's a non-refundable credit, but it can be carried forward indefinitely. So I guess you have all the time in the world to use it.
So you don't want to overpay by too much. Yeah.
Yeah. And in these kind of cases, they're planning situations around that where you can, depend on the situation, elect every other year or something
Yeah,
like
to use
that,
it.
to
Yeah.
use up your credits. So it's going to be an election made every year. Missouri doesn't have like a separate election form. They kind of have this MOPTE, electing entity return. But one interesting thing is they still have to file their regular Missouri 1065 or 1120S PT return, the historical return for S corps or partnerships, in addition to this MOPTE. They're a state that doesn't have any ownership restrictions or limitations, based on the partners or shareholders that you have. But it's just one that if you make the election, they're going to compute the tax on all the partners, all the shareholders. So there's no individual opting in, opting out. For the most part, that tends to be the general rule. Most states say if you're going to make this election, unless we carve somebody out, it's just going to apply for everybody who would be eligible. With the exception of a few states like Arizona or California, kind of allow that approach of like separate, I want in or I want out, and they have the option to do that. The PT tax rates, individual tax rate in effect for the tax year, which is pretty standard, I think, for a lot of states. You tend to see that they just say, the tax rate in effect for the tax year, specifically that amount, but it equals, the same individual tax rate that the state has. One thing still trying to sort out, with Missouri right now is by statute, non-residents are relieved of a filing requirement if they don't have any other state source income. But then the Missouri Department of Revenue issued some regulations that were recently finalized. And so within them, they had stated that, but PTEs are still subject to a withholding requirement that they were always subject to for non-residents. So, taking these two together, you're like, well, in order to avoid paying the PTE tax and the withholding tax, there's a few different combinations you could go through there where, the individual could execute a withholding waiver, but then they would still have to file the non-resident return, or they could jump into a composite return as a substitute for the withholding. So
hopefully they'll correct that. It sounds like it was just missed, and California didn't change their withholding requirements either.
yeah.
So you have to watch those. Is the withholding relieved or not? So
Yeah, it just kind of left me scratching my head going like, well, what's the point?
Yeah.
Like they kind of almost seem to oppose each other a little bit. It just takes a little more in the planning side of things. And,
Right.
Depending on before, if you had partners or shareholders that were non-residents and were already just filing their own separate non-resident individual returns anyway, and used to that kind of filing every year, then it's not really as big of a deal. But
and so as we move forward, Tony, let's pick up the pace a little bit so we can get to the issues at the end, because there's a lot of issues and there's some good questions coming in that I'd like to get to.
Sure. Now we've covered a few. I feel like everybody's got the format, and you'll start to see some of the similarities here. North Carolina, another one that it's due for 22, but has kind of been enacted and on our radar for quite a while here. So another income reduced method state. It's annual election made on the same partnership or S corp return that North Carolina had before. They're another state with a pretty restrictive ownership requirement. S corps are going to be eligible just because the federal rules are going to kind of already take care of, you're not going to have C corp owners and other partnership owners. But for partnerships, it's another one where if you have, as they say, like not a partner who's not an individual estate or a few entities or trusts that they list in IRC 1361, then the entity is just ineligible to elect to begin with. So hopefully another one that we can see some change here. Same rate as on individuals for the tax year. North Carolina is a state where it's going to be North Carolina source income for non-residents, but it's the entire distributive share of income from the entity for North Carolina residents. So a bigger opportunity there for North Carolina residents if they can make this election to, capture more income at the entity level, a bigger deduction, and more benefit from the workaround. North Carolina, they're going to relieve non-residents of any further filing requirement. And North Carolina never allowed partnerships to file composite returns to begin with. They did for S corps, but either way, if you elect, you just not going to file a composite because you just don't really need to.
Hey, Tony, there was a question that came in for North Carolina. If they already filed their pass-through entity tax return, they find out it's beneficial to the owners to make the election. Are they able to make that election? And I think in North Carolina, the return still has to be under extension. And as long as you get the amended return before the extended due date, you may be able to make the election. So if they already filed their pass-through entity return without making the election, can they amend that and make the election?
I know there is a limited window to either, elect or revoke to change it.
And I believe it's only up to the extended due date. So you have to really look at once that extended due date is passed, generally, I don't believe in North Carolina, you can.
Yeah. For a few of the states, I know South Carolina's kind of got the same thing, that it's up to the extended due date. But that's a hard stop at the extended due date. Consult the Department of Revenue. It'll be referenced here later on here. Important notice, PTE tax, latest revision, December 2nd, 2022. There you go. Hopefully you should
so
find
you'll have that reference here later of where to go to specifically read about it. Okay,
it's in there. Yep.
Okay.
Ohio, another new one, a credit method state. So it's an annual election. So Ohio created a new form for this one, where previously you either had the IT 1140 withholding return for non-residents or the 4708 composite return. So this is like a new third option for the PT return. It looks pretty similar to the composite return, the 4708. It's Ohio doesn't place limitations based on the owner type. So if they make the election, the PT tax is going to be computed on all of the owners.
And let me interject there, because some I mentioned to you earlier. So if you make this election and you have a corporate owner, right, you're still, you'd be paying tax at the pass-through entity level. Ohio does not impose a corporate income tax. So you would not want to make an election if you have a corporate owner with any significant income flowing through, because right now the corporation is not subject to Ohio corporate income tax, because there is no corporate income tax, and you would actually be creating a tax that didn't otherwise exist.
Yeah, and this was confirmed. I double checked this here. It's in the FAQ the Ohio Department of Revenue put out, and they state that specifically. Yeah. Well, I had to make sure on this one. We're like, it seems like maybe they would offer some kind of credit refund. No, they don't. It's pretty clear in there. So if you've got a partnership with the C Corp partner, they're still going to compete the tax on them.
Yeah.
And there's no refund opportunity for the credit, because they say as it's statutes worded there, the person eligible for the credit is individual or something like that. Like corporation isn't in that definition. So too bad. So sad. No credit.
Yeah. Okay. Any other comments on this one, or should we move on?
We can move on. It takes care of the non-resident filing requirement if they make the election. Because really it's just a replacement for withholding and composite.
Yeah, and you can read the slide and see kind of those other comments. Yeah.
Virginia, it's a credit method state. Annual election, Virginia created a new separate return for the electing entity, a 502 PTET. So if you're going to make the election, you would just file this return instead of just the regular 502 PT return that Virginia historically has had. Another state that'll say currently has a pretty restrictive ownership requirement, where they say S corps can elect, but basically this limitation comes down to partnerships that have to be 100% owned by what they call natural persons. And in further guidance, it said like, okay, disregard entities like single member LLCs and grantor trusts are okay if they're just the actual owner is going to be a human. They actually say a human being, as opposed to a being created by operation of law like a corporation. So yeah, as long as they're owned by a person, then they can still elect. Otherwise, non-residents would be relieved of a filing requirement. In Virginia is another state where they would compute the tax on that entire undistributed share of income for Virginia residents, and then it would just be Virginia sourced apportioned or allocated income for non-residents. However, we have a new piece of legislation that Virginia introduced in January, the start of their new legislative session, which is currently sitting on Governor Youngkin's desk. And I checked even right before this presentation just to see if, oh, wouldn't it be great if it updated and showed that, it was enacted and signed right before this. Unfortunately, it hasn't. But things look promising, I hope.
And
The
that
bills went
legislation
through the,
saying that you don't have to have all individual owners, right? You can
Yeah.
have other owners and you would just pay the tax on the individual portion. So you wouldn't be disqualified per se.
yeah. So
there's
this
a
would
lot
really
of-
open up the election to a lot more
Yeah, and
taxpayers.
I can't imagine him not signing it. I think it's just
Yeah.
it's just a matter of time.
So I think it's a pretty fair compromise,
Yeah. Okay, next polling question, true or false? Virginia is an income reduced method state. So again, you're taxing at pass-through entity level. Once the individual files, do they remove the income from their tax return or do they get a credit? So are they an income reduced method, true, or are they one? Yes. True or false, whether they are, yeah. And we'll give it a few minutes here. I might be able to take a question while we're doing that. Okay, so one, if a Georgia resident has Georgia pass-through entity from an entity or income from an entity, can they still get credit for other state taxes paid by the pass-through entity for another state? So Georgia resident, can you get credit for taxes paid by the pass-through entity in other states? And we would say that generally it's a deduction. So Georgia actually has a deduction for income that's taxed at the pass-through entity level in other states. So you wouldn't get a credit, but you would get a deduction for that. And another one I'm just going to touch really briefly on. I'm not sure if you know this one, Tony, and something that I would always go back and check on, but Georgia eligibility for pass-through entity election, be an S Corp owner. So what about an ESOP? You have an ESOP that generally is not subject to tax. Would you make that, would they be subject to tax if they made that election? You might not know offhand. We might have to look at that one, but that's a great question because the employee stock ownership plan, that's an entity that generally doesn't pay tax under, federal state authority. And if they're an owner and an S Corp, kind of like the Ohio C Corp example, did you just take their portion of income and subject to tax? You know that one offhand, Tony?
Well, I know in the regs, they do offer, they cite two different Georgia statutes where they say in these exceptions where it's exempt entities, where the entity can just not compute the tax on it for them.
Okay.
Otherwise for S Corps, I mean, Georgia's rules and, an S Corp is owned by persons eligible to be S Corp shareholders. Well,
yeah.
Okay, well, that's, the definition of
So
an
it
S
really
Corp.
comes down to what income is actually in the income tax base. And you're saying that Georgia has a provision that if it's like exempt type, you may be able to deduct that. So we're not going to give tax advice on this webinar, but it appears like that Georgia, you'll want to check, but it appears Georgia has taken that into consideration and may not subject that.
Yeah, if I recall offhand, that statute references like 401, 501 entities. So, yeah.
Okay, so most of you got this correct. Virginia is an income reduced method state. There's one other question I'm going to hit before we go to the next slide. How do most states treat tiered partnership with regards to electing pass-through entity tax? And I would say it depends on the state. Some states, they just carve that out and you can still make the election, but you just carve that out. And as you go up the chain, you'd make the election at the upper tier to do the pass-through entity. Some states you're ineligible to make the election at all. Tony, do you know of any in some state? Yeah, in some states like the ones Ohio, Missouri, they would just calculate it at the lower tier.
Yeah,
right?
Illinois, Maryland, come to mind here where they compute it
up
the tier. Yeah.
You would just get a credit as you go up the tiers in those situations.
Yeah, and in the upper tier, they would just first you would subtract out any of the income before from the lower entity that's already been subject to the tax, so you don't keep recomputing the tax and snowballing it.
Yeah,
every
you
time.
wouldn't have a double tax. Okay, we got to fly through this because we're already for
Yeah.
your mind. So I apologize for that. So, and it's a lot of this stuff we already touched on, but any
Yeah,
highlights
yeah.
on this slide, and everyone else can read it, Tony, but
Mhm.
highlights.
Right. Some of the issues, just, keep in mind with credit states may not always be a refundable credit. There's just a few situations out there they're not. Virginia, Colorado, really only two states that are kind of going with like retroactivity.
Ugh, yeah.
And to those, well, there's still guidance pending. We're still waiting, no. So
Yeah.
we just know that they're out there. We'll have a separate webinar about those, I'm
Yeah,
sure.
there you
There'll
go.
be a lot to talk about with those.
Yeah.
The base of income, that resident, non-resident issue, can vary based on the state. If you want to keep
That's it on that. So it's basically reiterating things that we've already talked
Yeah.
about.
Reciprocity states, for any of these states like Arizona, California, Virginia, these are just some weird ones where because their reciprocity would be non-residents claim a credit for taxes paid to other states on their non-resident return instead of their resident return in these states. So keep in mind some of the credit ordering rules, and you need to plan a little bit more around some of these situations to make sure you would be able to use
The way
all
the
of your
credits
PT
work.
credit.
Yeah, how the credits work. Yeah.
Yep. Otherwise, just a few other entity limitations with North Carolina, especially. This is just one of the instances still out there with the credit for taxes paid to other states where they're not exactly playing nicely with everybody else, although they've enacted their own PTE tax. So unfortunately, still just an issue where, you don't face it with S corporations, but in the situation where you've got a partnership that doesn't make the North Carolina election, but has North Carolina residents, and they make elections in other states. North Carolina is still sticking to this position that resident won't be able to claim the credit for taxes paid to other states for those PTE taxes in the other
Yeah,
states.
and I would say it appears to me there's some statutory authority otherwise that you would get a credit. And I think most North Carolina residents were taking a credit, but this creates confusion with this notice now.
Yeah.
So we just wanted to point that out.
Yep.
Okay.
As noted before, you still have some states out there that are just going to disqualify the entity entirely based on some of the ownership composition of the PTE. Just to keep in mind, and there are options where possibly there could be some restructuring or that you could do to eventually get to an entity that would be eligible to elect. Hopefully the states just pass some technical corrections like Virginia is doing right now to alleviate the issue and just say, we'll just disregard them. We'll just compute it on the individuals, of the entity. Being locked into an election, you've got a few states that, once you've made that election, you're going to be locked into it for more than just that one tax year that you elect. Michigan is just one state where you're in it for that year and 2 additional years. Louisiana, you're locked into it, but they don't really have a revocation form like they have an election form. They say you've got to make a private letter ruling request to get out of it.
Louisiana,
so kind of burdensome.
And even to make the election, you have to provide a ton of information to Louisiana. And so, if you're an S Corp, you can actually be treated as a C Corp in Louisiana, which may be actually easier to do.
Yeah.
Okay, retirement income. When you have retired partners and they have actually retirement income on their K-1, there is a federal law that most people I'm sure know about, that if you retire and you move to another state, only the state of residence can tax that retirement income. So it's not like a portionable business income, and it's a federal law. Federal law always trumps state law, right? So these 3 jurisdictions have addressed it. Most of the states have not addressed it, but they're basically saying that if you have a retired partner and it's a state that's unallocated and apportioned income to the state, and that's a non-resident partner, the state can't tax that. So it's not included, right? So federal law prohibits taxation of retirement income on non-resident partners, right? It's only the state of residence that you could even tax. So you have to watch kind of those retirement or type of income that you have. Have they addressed guaranteed payments, separately stated items? You have to look at each of the states, and once you're eligible for the election, you make the election, what's the actual income that can be included in the election? So there are many issues related to that. Investment income, tiered partnerships, we talked a little bit about in that question. when we get to the deductions, right? So this is a federal deduction, so it's really a federal benefit. You really have to look at, okay, what is deductible from a federal perspective? Can you, if you have an investment partnership, are the taxes related to that investment income deductible under if you make this election? Maybe, is it a business? Is it a pass-through entity engaged in business? So, potentially you're going to want to consult your tax advisor for that. You're going to want to look at it to make this, because some states have 100% of resident income that's taxed, but only allocated and apportioned income that's taxed for non-residents. You have this like disparity. So if you're in an S corp, you're going to have to watch that you don't create second class of stock on equal distributions, right? So you're gonna have to make distributions to make them equal. Also, you're gonna need your partnership agreement to allow you to allocate the deduction to go to the right partner. So here we get into actual specific allocations of the state tax deduction, which is a deduction in that line 1 ordinary income. Because if it's equal pro rata with all the partners, that's fine. But if you have 100% of residence income, only a portion income for non-resident, I would think you want to get that deduction to the right partner. So there's some complications there. Does your partnership agreement even allow you to do that? You have to watch estimated payments, that it's the correct entity or the individual making estimated payments. You have to make it in the entity level if you're making this election. Do the owners still have to file? Some states may increase the burden if there's a lot of owners. All the owners might have to file. Maybe there's no composite election anymore, like California comes to mind for that. It may increase the compliance burden. Timing of federal election, the notice indicates that it's paid, specified income tax payment. So is the notice actually saying that you can only use a cash method basis for the deduction of the state income tax, where the accrual method basis always allowed the deduction if it was a recurring item, if you met the certain exceptions for it? So there's some questionability there. The AICPA actually is send a letter to the IRS asking for clarification. To make sure you get a deduction, you want to make the payment in the year you want the deduction to make sure. Mention the S corps. Financial statement impact is, do you have ASC 740 issues now because this is a tax imposed at the entity level? I think the short answer is the guidance really says that, well, the owners are still liable for that tax, so it's not included in ASC 740 computations. That concerns me because the IRS, this has to be a tax imposed on the entity level for the whole SALT workaround to work, right? So then you're saying, oh, this is a tax on the pass-through entity level to get the deduction on the federal tax return. But then for financial statement purposes, we're saying, oh, no, this is a tax on the owner level. So that causes me a little bit of heartburn. Maybe some others aren't concerned about that. Maybe I worry too much, Tony. I don't know. But yeah, so partnership agreements, you may need to amend to accommodate, that deduction. Who can make the elections? Does it take consent of owners to make the election? Who's authorized to make the election? Do you have to designate the tax partner, the delegated partner for those elections? Do you have any owners that are going to be hurt by the election? Then you might get conflicts between owners. So you do want to make sure that you have the person authorized to make the election, making the election, so you don't get those kind of, if there is a conflict, you can have some issues there. If there's a change in law at the federal level, if you're locked in, I don't see in most situations harm in that, but just know that you may be locked into that election. So we are going to go to polling question number 4, and we might even be able to get another question. I think we got it. And Tony, if we have more time too, maybe we can elaborate on something if you think I went over something too quickly. But the last polling question, would you like to learn more about how we can help moving forward? So would you like Cherry Bekaert's additional information? Yes, no, maybe in the future. So feel free to answer that as you will. I'm not seeing, I know there was a lot of stuff going on in the chat previously. Not seeing any more questions in the Q&A. Was there anything, Tony, on just these last slides? We went through it in a hurry. And I think, I think really people ask, well, what can I put in a pass-through entity to now convert my non-deductible tax to a deductible tax? And I think that's where people are going to really start thinking. You have to be careful. Step transaction doctrine, business purpose, the pass-through entity has to be conducting a business, all those kind of things. But anything I missed, Tony?
Thank you to Vicky in the chat. Note on North Carolina. I'm going to look that one up. Thank you for the heads up on that. So.
And what was that with North Carolina?
Maybe a technical correction similar to Virginia. Fingers crossed.
Oh, there may be. Oh, awesome. Awesome. That's great. That's great.
Yep. And Kathy, I did see one question. How do states treat tiered partnerships with regards to electing PTET?
Yeah. And so I had mentioned that before, that either it's carved out, you're allowed to make the election and it's carved out, or you have to go up and make the election. And then you make the election as you go up. Or if it's a credit and they're included in the tax, then it gets reduced or creditable as it goes up the tier. So it depends on the state. That's always our answer, right, Tony?
Yeah. But thankfully, there's just some mechanism in place where you're not just going to keep recomputing the tax or something, in tiered situations. So.
Yes, exactly. You shouldn't be harmed. So we want to, right at 2:00, we're getting better, Tony, at that. So we want to thank everybody for attending. We reduced our disclaimer to really small print down there, but we're just saying you can't rely on anything we said. Go talk to a tax advisor. And we're really happy to be with you here today. We'll have another webinar in the future to get more updates and see what the remaining states do about their pass-through entity elections. But in the meantime, if we can help you in any way, just please reach out. Thank you so much for attending today. We appreciate it. And thank you,
everyone.